Welcome to another video. Today we are going to talk about dollar cost averaging. Dollar cost averaging is the simplest form of investing and the easiest way for the average person to get rich. This method requires very little knowledge of investing, luck, or decision-making ability, but provides investors with unlimited potential. It reduces risk and helps maximize returns for long-term profits. This process couldn't be simpler, making this an excellent strategy. To utilize it, let's take a look at exactly what it means to dollar cost average, what this method would look like for you, and how you can implement this strategy to become a multi-billionaire on autopilot. Additionally, let's see exactly where you can invest your money to receive excellent returns for doing absolutely nothing, often returning 10% per year or higher. My name is William, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Dollar cost averaging is a method that entails investing a fixed dollar amount of money on a regular basis, whether it be weekly, monthly, or even daily, regardless of the price fluctuations of the investment. Let's say you begin to invest $500 every month into an ETF that share price is $100, and just like any investment, the value fluctuates day to day. During the first month, your $500 investment buys 5 shares of the ETF. The next month, the ETF might be priced at $80 per share due to market volatility. This means your $500 will purchase 6.25 shares. Now, at month 3, the ETF has recovered its losses and risen to a price of $120. So your $500 investment only purchases 4.16 shares. Of the ETF is up, your $500 will buy fewer shares. But when the market is down, your money will go much further. This is fantastic, because the decision of how many shares to buy is made for you. Over time, this strategy could lower your average cost per share compared to what you would have paid if you had bought all of your shares when they were relatively expensive. One of the main benefits of dollar cost averaging is that it can be done automatically by setting up a regular contribution to your investment account. This can be taken directly from your paycheck and directed into a 401k if your employer offers a 401k, or it can be withdrawn from your bank account and directed to an IRA or other account. The great part about automating the process of investing is that you're more likely to do it every single week, month, or whatever period you decide. Without an automatic contribution, you're much more likely to decide not to invest. Just imagine when your paycheck hits your account every other week. Now you must ask yourself if you should invest and how much you should invest, or if you should skip investing this week and use that money for bills or other expenses. Skipping 1 week won't hurt, right? It sure would be nice to use that money towards a night out. 1 week won't be detrimental to your retirement. But skipping here can create a destructive habit, becoming more and more frequent. Automating the process and deciding when and how much you will invest ahead of time makes investing easier to do on a continuous basis with no interruptions. Besides, when the money is automatically directed towards your investment account, you're much less likely to notice it's missing from your paycheck or checking account. By investing the same amount of money regularly, there's no need to worry about buying at the wrong time. If you sink all of your money at once into an investment, there's a risk that you're investing right before a big market downturn. Imagine you had sunk all your money into the stock market in 2007, right before the Great Recession. You would have ended up losing much more money than if you had implemented a dollar cost averaging strategy and invested smaller amounts over time. By dollar cost averaging, you would have invested a small chunk before the market tanked, and you would have continued investing smaller chunks as things progressed. On the other hand, you might also miss out on investing at just the right time before the market begins trending upward in a bull market. Imagine you suddenly find yourself with an extra $1 million that you plan on deploying into the market but aren't sure of the best approach. Should you invest all $1 million at once, or implement a strategy to invest a portion of it regularly over the next year? Investing it all right away means that you'll be in the market for a longer period of time. Investing a little bit over time will ensure you spread your eggs out instead of putting them all in one basket. A study by Northwestern Mutual found that over a 10-year period, returns on a $1 million chunk of money invested immediately in the stock market perform better over the same amount of money invested evenly over a 12-month period. The 10-year returns for the $1 million sum invested immediately beat the dollar cost, averaging strategies 75% of the time. While this is a general representation, the answer to which is best comes down to how the market is going to perform going forward. Of course, if you had a crystal ball and knew the market was going to rise consistently with no downturns, your best bet is to invest everything immediately. The problem with this strategy is that you're hoping the market doesn't nosedive right after you invest, because that would take a big bite out of your $1 million sum. The best decision is usually investing everything at once because, historically speaking, the longer amount of time you're invested, the better. Unfortunately, most people don't have a huge amount of money they can throw into the market. Instead, they can set aside a small amount from each paycheck and dollar cost average into the market and enjoy the benefits of that strategy instead. The best single thing the average person can do to build wealth is investing reliably over an extended period of time. This means investing when times are great and the market is booming, and when things are terrible and stock prices are spiraling down. Due to the lack of decision-making and the stress you'll encounter when dollar cost averaging, this makes it an amazing way to build wealth. Basically, anyone who's able to automate their investment contributions and forget about them can be a successful investor. By making the process automatic, you're not going to panic as the market drops, like many people often do. This causes them to either stop their contributions or sell everything out of fear and uncertainty. When you continue investing during market downturns, you're taking advantage of buying opportunities through all market cycles. By purchasing as the market is dropping at the bottom and on the way back up, you'll be greatly increasing your chances for large profits. Now, where can you invest your money to receive excellent returns that will snowball your portfolio so you can become financially free? There are many options varying from actively traded mutual funds to individual stock picking to buying cryptocurrency. But sometimes the best choices are the simplest. Buying into the S&P 500 is an amazing investment for many reasons. Firstly, S&P 500 funds are available to pretty much everyone. There are so many extremely low-cost options, meaning the fees charged for owning some of these funds are extremely low with companies such as Vanguard or Fidelity. Buying into the index means you own the 500 largest profitable companies in the United States across all market sectors, from technology to consumer staples. While exposure to sectors varies, you're still going to be diversified across all industries. Furthermore, if a company is no longer profitable, it will be dropped from the index. Simply put, you're investing in large, profitable U.S. companies across all industries with little to no cost to you. From 1957 to 2021, the S&P 500 has averaged 10.5% annually, providing you the ability to earn excellent returns from this proven investment. It's no surprise that Warren Buffett recommends most people invest in this index. Dollar cost averaging won't always provide you with the most money over time. It'd be great to invest a large lump sum for your retirement at a young age, but this simply isn't an option for most of us. Thankfully, there are many advantages to this strategy that can help the average person build incredible wealth. It requires zero time or effort once the process has been set up. You don't have to check your portfolio every single day, panicking as the market moves up and down, wondering what your next move should be. By taking the emotions out of investing and making it an automatic process, finding success with investing is attainable. Let me know in the comment what you think about this video. Thank you for watching. Please like, share, and subscribe the channel.